Hey, good morning, everyone.
Morning,
Good
Professor.
morning.
Yeah, hi, good morning, Angelica, and good morning, Naomi. Morning, Jeremiah and Nicole. I have good morning, Vivienne, Noel. Um, all right, so I see six people in the collaborate session, and let me see how many are in today's forum. So seven people in today's forum. So still one more person needs to join our collaborate. Um, all right. So let me, not that one. So let me continue. Let me open this file. Yeah. So in our last class, we talked about Muni bond, right, and find how to compare Muni bond with corporate bond because or even treasury, right? Because corporate bond uh, is subject to taxation, and uh, while the muni bond is exempt from tax. So you cannot simply compare these two um, based on their stated yield. Um, so we talked about how to compare it. Um, in dollar terms and also in percentage terms, because in other words, in yield terms. And then we need to then talk about the tips. Now, tips is literally in Treasury inflation protected securities. In other words, this is Treasury bond, but the bond price will be adjusted for inflation. Okay. So the inflation is generally measured by CPI, Consumer Price Index. Actually, these days, more widely used, index is PCE, Personal Consumption Expenditure Index. But still, macroeconomics, in macroeconomic sense, CPI, Consumer Price Index, is quite widely used. And CPI, there are three broad three categories or three types of measure of inflation, three types or three measures of inflation. The first thing is CPI. Second thing is PPI. PPI is Producer Price Index. Third one is GDP deflator. Producer price index is, of course, mainly for manufacturers because the items or the goods in the basket to measure the index. That basket is quite different from CPI because CPI is mainly consumer oriented. PPI is producer oriented. Um, so, but for most people, CPI obviously is more relevant. And of course, you can look up CPI from the Federal Reserve website, or from a couple of other websites. I will have to Open, yeah, open education resource, something like, uh, okay, no. Okay, CPI home, Bureau of Labor Statistics, right? So from Bureau of Labor Statistics um, collects data on unemployment, and then also CPI. So and there are even in CPI, okay, uh, CPI data. Let's interactive charts. And by categories, right? All items, it's about 6.2%. This is as of when? October, right? Food alone is by, that's inflation basically, 5.3. You might wonder, oh, is that really, the inflation in food? Actually, it seems more uh, higher than that or more pronounced. Well, actually, uh, this is, not month to month, but, like uh, year to year. So it's like, change between October 2020 to October 2021. See, 12-month percentage change, right? So during the course of 2021, there may have been some months where food prices may have um, gone up more month to month, but comparing year to year, that's what it is. Energy has gone up like 30%. Yeah. All items less food and energy, slightly 4.6%. But anyway, CPI is the CPI is the measure, broad measure, right? So where was I? So I'm gonna. I think I better copy that link and okay, that's bond valuation. Where did it go then? Where's my? Okay, I'm gonna put a link there. Okay, bond valuation. Okay, so you should be able to see this. Just click on that and submit, and let me bring it up. Yeah. All right. Then if CPI is, I mean, what you saw a while ago was the inflation actually, in percentage, but CPI is an index number. So it is like it's like, 100, 200, 300. Of course, 100 means that's the base year. Then what year is the base year? Well, there are frequently two base years that they use. Most widely used base year is 1984. 1984. You might wonder why 1984? Because 1984 was like uh, that was a bottom of the long recession we've had. 1970s was plagued with hyperinflation, not hyper, but high inflation, and then so and there was even stagflation. When there is inflation, usually moderate inflation. We talked about this in topic one. When there is moderate inflation, usually economy is growing. I've been telling you, inflation is a sign of the vibrant economy. Without inflation, that means the economy is not growing. That means the economy is depressed or dead. So inflation is not a bad thing. We talked about this early on. Accelerated inflation is a bad thing, but moderate inflation, modest and moderate inflation is a good thing. That means the economy is vibrant. But then as I said, 1970s was a period of stagflation. So as Reagan administration, 1979, that was the end of Jimmy Carter administration, and then 1980 was the beginning of Ronald Reagan's administration. And Ronald Reagan, they had to use, regardless of who's the president, the chairman, Federal Reserve chair, will have to implement tight monetary policy. In other words, they will have to tighten up the money supply to cool off the economy, to tackle the inflation. So they did, and during, in 1980, Ronald Reagan appointed Paul Volcker as chairman of the Federal Reserve, and Paul Volcker died last year, or if I remember correctly, he died last year or 2019, or so he implemented tight monetary policy, so the economy went into recession, and then so the economy bottomed out in about 84. That's why they use 1984 as the base year for CPI. Okay, but 1984 was almost like 40 years ago. If you want more recent base year, so the base year is always 100. Okay, the index CPI of the base year is always 100. So let me open. Okay. Yeah. Yeah, CPI of the base year, right? Base year is always not dollars, it's index number, so not dollars, but just 100. and the CPI, for example, and then the CPI of the year, let's say the current year, if it is 200, what does that mean? There has been 100%, the difference is 100%. There has been, the inflation was, the CPI has grown 100%, but the inflation was 50%. I'm sorry, the CPI difference in CPI is why. It's 100. I'm sorry, it's 100%. It's 100%, and then so let's say so if this is, if the base year is 1984, that's 100. Let's say CPI of year 2000 is like that. Then, that means between 84 and 2000, there was, 100% inflation, right? But that's almost 40 years, and that's pretty much, that's understandable. And then if CPI, then if CPI of 2020 was 250, 300, let's say 300. Okay, then between 2000 and 2020, this is a question. This is a bonus question, right? Bonus point question, extra point question. So answer me, please give, think carefully and give me a correct answer. So in 2020, if CPI is 300, between 2000 and 2020, it's 20 years. How much inflation was there? Anyone? How much inflation was there? You're awfully quiet, but that's not a good thing. If you're awfully quiet and you think, the storm will the storm will pass. If I just keep quiet, the storm will pass.
Professor?
Yeah, I'm here.
Is it maybe 400?
And who was this? Who is this?
Angelica. Maybe like 400.
Angelica?
500? Yeah.
Was it Angelica? No, think well. Think well, please. Please think well. The difference is 100, but that doesn't mean, think about it, from 200, if it went to 300, is that 100% growth? Now think carefully. Anyone else? Look, this is very, it's very basic math. I mean, math, it's logic, actually, math is logic, basically. If it would be 100% if the, it will be 100% if it grew from 100 to 200, that's 100%. But from 200 to 300, what's the growth rate? Inflation is growth rate.
Sorry. Would it be 50%?
Yeah. Who said that?
That was me, Nicole. Sorry, I have construction going on in
Nicole.
the back, so it's really loud.
Okay, so that's Nicole, right? Yes, you're correct. Nicole, you got it right. Yeah, think about it. Inflation is nothing but growth rate of the price level, right? Uh, yeah, so it's 50%. Okay, Nicole, so you got, Nicole, I'll give you 0.5 point for that. That was a good answer. Um, yes. Now think about it. Yeah. Um, so that's how you find the inflation. In other words, what in your mind, whether you did it, mentally or not, but the logic is, um, the logic is, um, 300 minus 200 over 200. Isn't that right? Hmm? In This is net growth rate or net inflation. I mean, but if we just in gross growth rate, just 300 divided by 200, which is 1.5, which is 150%. Now, one is including to itself, right? Because 200 is already included in 300, right? One is already included, so that's gross growth rate. Whereas if you subtract one, then that's the net growth rate, right? Makes sense. So if you understand CPI, then the rest of it is pretty easy. Where was I? This wasn't it. Yeah, here. So let's take a look at this. At time t, so they are basically making adjustment to the par value of the bond, right? They are making adjustment for that inflation, right? So as par value changes over time, that means because they make adjustment to the par value for that inflation, interest payments also change. The delta always means delta is a symbol for change, right? So at maturity, that uppercase T means terminal time. So that's maturity. At maturity, investors receive inflation adjusted par value. So consider a 10-year TIPS issued on January 2007, paying 2 and 3/8% coupon. You understand 3/8, this peculiar quotation, right? Treasury uses 30-second system. You remember that. So even the coupon rate, they use 2 and 3/8. We can easily convert it into a just regular, decimals. CPI for these bonds is 201. Let's just say 201, right? Because it's, I don't like it, it's mouthful. I don't want too much verbiage, mouthful. I mean, 201.66, what's the point? Later when we calculate it, we can just punch in this number, right? But when we say it, just 201 or 201.67 or 66. Now, that was the CPI that's January 2007. On January 2010, so 3 years later, CPI was 216. CPI was 216. So think about it. The CPI grew roughly about 16 points, right? It's like 15 points, but let's say 16 points. And then you can tell, then the inflation between 2007 and 2010 was about 8%. Why 8%? Think about it. The difference between these two numbers is 16, right? 16. And then, assuming that this is approximated as 200, 16 over 200, right? It's 8 over 100. So it's roughly about 8%, right? Over 3 years. So now what we need to do is we make adjustment to the par value, right? For that, inflation. So in other words, you can multiply 1,000 by, 1.08, but the exact number is 7.231%, right? How did they get that? Yeah, like this, 261 divided by 201, right? Remember? They used gross inflation, gross growth rate, gross, and then you simply multiply. So if there has been 1.5 times, if price level has grown 1.5 times between these 2 years, then to make adjustment to the price, then you need to multiply it by 1.5. Isn't that right? Anyway, 50% inflation to make adjustment to the price level, right? You will need to multiply everything by 1.5, right? 1 plus 50%, right? 1.05, 50% is 0.5, right? So 1.5. So just like that, between those 2 years, not that one. Between those 2 years, if you take the ratio, if you divide this one by CPI of 2010 by CPI of 2007, if you take the ratio between the two, it will come to 1.07231. Then you multiply it by 1,000, then it comes, of course, and then 1,072. So the par value has been adjusted for inflation. The par value has been adjusted for inflation, right? Of course, if you sell it at the time, but you won't get this. You will get whatever the market price is, but at maturity, if this was maturity, 2010 was maturity, you'll get this. You'll get maturity value, and then the interest for 2010 will be simply 2 point whatever this percentage is, and if we convert it into a regular decimal, it comes to 2.375%. So you multiply this percentage to the face value, the maturity value of this, then it will give you something like 1 year. It will give you something like $25, something close to $25. I think it will give you exactly. It will give you something close to $25, but that's annual, and bonds pay interest semi-annually every 6 months. So then half of that number, so divided by 2, so semi-annual coupon will be 12.73. Okay, so if you just to verify, let's double check. The CPI, first of all, 1,000 times. What was the CPI? 216, 2461. Come on, move. Why Why isn't it moving? Okay, now it's moving. 216 point. Uh, 2461 divided by 201.66452. Yeah, so we got 1,072, almost $30.31, and then times the coupon rate is 0.02, 2 and 3/8. I think I will need to put this in the parentheses first. So let me open parentheses here. 0.02 plus 0.01 times 3 divided by 8, right? It's 3/8 of 1%, so that's why 0.01 plus 3 divided by 8. Yeah, it comes to, so this comes to 2.375%, right? But multiplied by 1,072.30, right? Hit enter. Oh, there was 0. What happened? I will have to. Why there was 0? Oh, come on. Let me do this again. So I will recall. How do I recall this? I'll just copy this number. Times, open parenthesis, 0.02 plus 0.01 times 3/8. Enter. Yeah, that's the annual coupon. So if you divide it by 2, I should give you something like this, right? Semi-annual, 12 points. So, so that's how you calculate the. That's how you adjust the tips, right, for inflation. So it's not a difficult thing. This is just, pretty much, accounting, nothing but accounting. There isn't much, right? Accounting doesn't require much logical thinking. I mean, it requires on a higher level, but, not much, higher level math, but just, pretty much, low level math is okay. So that's tips. And we already talked about muni bonds. So that takes care of all the institutional aspect of bonds. So now we start with valuation. Valuation of, first of all, valuation of zero coupon bond, which is quite easy, and the valuation of and then next valuation of coupon bond, which is also easy. Now, zero coupon bond is the bond that doesn't pay any interest. So all you need to do is, we just need to discount the par value by the discount rate. Okay, and the discount rate is the prevailing rate in the market. Bond with par value of 1,000 maturing in 20 years and price to yield 6%. Now, price to yield 6%. This remember this. This is the way it is worded. They don't tell you straightforward. Use this as the discount rate. Okay, use this as discount rate. You will never find anything like that. There's no such, there is no such wording. There is no way any problem is phrased that way. Usually the way it is phrased is like, a bond is priced to yield 6%. That means use the 6% is the yield. Use it as the discount rate. The 6% is the yield, so use it as the discount rate. That's what it means. Okay? Or another way it is worded is prevailing market rate is 6%. Prevailing market rate is 6%. Or another way it is worded is the bonds, similar bonds, or the comparable bonds pay 6%. Right? Comparable bonds or similar bonds mean bonds of the same or similar risk class. The bonds of the comparable risk class. That's what it means. So if it says, similar bonds pay 6%, that means that's the Q, right? That's the Q. That's the discount rate. And it already said, the bonds price yield 6% might be purchased for about 306. They already gave you the answer. But why 306? All you need to do is you discount it for 20 years. So it's a single cash flow model, present value of the single cash flow. So it's not difficult. All you need to do is, but then one thing you have to remember is, well, it was 6%. Why 3% here? Why did they discount it by 3%? And wasn't it 20-year bond? Why raise to 40? Look, if all the rates are annual, but bonds are on semi-annual timeline, semi-annual time frame, okay, or semi-annual cycle. And you might wonder, that's the coupon bond. That's the case of coupon bond, but this is zero coupon, so it's not even paying any interest. But why should we follow? Regardless, right? Unless the problem has specified the bond is on annual cycle, the default is always bonds are on semi-annual cycle. Okay, so you will need to, in other words, that means half year. In other words, periodic rate is 6%, and then there will be 40 semesters over 20 years. So we discount it this way, then it comes to 306.56. Okay, so this is the fair value or rational price or intrinsic value. Okay, that means market price may be different. So that's why it says might be purchased for about 306. Might be. It's not saying it will be purchased. It can be purchased for about 306. It didn't say that. It says might be purchased for about. That means the market price can deviate from this. If the market price is lower than this, that's a good deal for you. If the market price is higher than this, then that's a bad deal for you. Right? If market price is higher than this, then market has overpriced this bond, right? Which is a bad deal for you then. Okay? So intrinsic value, rational price, fair value are at the opposite end of the market price. They are juxtaposed, Market price is irrational price. Most of the times, market price is irrational, right? Why is the stock market fluctuating, every minute, every day? I mean, since like over the last, like over the last 2 weeks, about 2 weeks, I should say, the market lost overall, like 5%, and every day, every over the last 2 weeks, every day, there has been a lot of fluctuation, going up, going down, going up, going down. Why? If the market is rational, and if all the market participants are rational, there shouldn't be so much volatility in the market. But there's a lot of volatility, and sell they just sell at even the slightest cue. And with Omicron variant um, uh, spreading, the market is reacting, overreacting. Always the market is overreacting because it's not market participants are not rational in the short run. Market is rational in the long run, but in the short run, everyone is just jumping the gun. That's stupid, in other words, but a lot of individual investors are just average Joe. An average Joe, it's in the nature of average Joe. Average Joe is in the short run an irrational, gun toting, gun jumper, just overreacting all the time. If And that's why they are still buying. There's Because market participants are average Joe and um, irrational. That's why they are still buying Bitcoin. And also institutional investors, they are not because they are irrational, but because they want to take advantage of this volatility, right? Because they have to make money, regardless. All these portfolio managers, they have to make money out of trading. So regardless, they will trade. They want to just even day trade just to make quick uh, buy low, sell high, even during the day, multiple times. But when it averages out, then they lose. So this is so that's why we should maintain strict discipline as an investor. You should maintain strict discipline and do not be swayed by a small cue in the market. All those noise, you shouldn't be cued by noise. You shouldn't trade cued by noise. Okay, but if you trade cues, so that's why there is a market price and intrinsic value. And if you just react irrationally, then you will be always at the losing end. So it's strict discipline. You shouldn't be swayed by small. So well, that's all the time we have for today. Any questions? Any questions so far? No? Okay. I don't know if you are still there or breathing, or show some vital sign, please. If there are no more questions, yeah, I'm gonna. So we'll call it a day, and we'll see you next Tuesday. Okay.
Bye, Professor.
All right. Take care. Have a great afternoon, Angelica and Naomi and Carol. I'll see you guys next Tuesday. All right. I'll stop sharing, stop recording.